If you're the kind of person who likes to watch the markets closely, your lifespan has probably been shortened by many years in the last few days. Check out the tail end of the 3-month Dow Jones chart here, looking like the plot of an episode of Squid Games with that hook right at the end to keep you coming back. Though zoom out to the 5-year chart and realize that despite the short-term drama, we're still pretty much banging off the red line of all-time highs here. So while my portfolio is up green across the board, as I'm sure yours is today too, I'm going to tell you why I don't think this can last much longer, and some ways we can prepare our portfolios for some of the chaos that could be on the horizon. After all, the markets dread uncertainty. We're going to take a look at some of the international news bits, and we'll finish with what I think is the greatest impediment on the broader markets trending upwards for much longer. My name is Trey McKee with Benevolent Investors, where we grow our investments tactfully so that we can bless the crap out of our families and communities. First off, Russia's recently stationed about 100,000 Russian troops all ready for action on the Ukrainian border. You may remember back in 2014 when Russia annexed the Crimean Peninsula. Here's a zoomed out map of Europe with Ukraine sitting right in the middle. If you zoom in a bit on the map, the island is right down there in the Black Sea. The entire Western world obviously flipped out at this old school annexation, but surprisingly, what we didn't hear much of was the fact that in 1954, Soviet leader Nikita Khrushchev actually gifted the Crimean Peninsula to Ukraine, basically for adopting the Soviet narrative that the Ukraine is part of and subservient to Soviet leadership. And it seems that pushing that narrative is the main theme of this year's drama as well. If the Ukraine really is brother to and part of Russia, moving military into the space shouldn't be seen as dramatic from the Russian way of thinking, right? But to the rest of the world who sees Ukraine as its own country after departing from the Soviet Union in 1991, this is obviously unacceptable. So the US is attempting to put in place some sanctions and pressures on Russia to defuse the situation. One of these moves would be to have Germany stop the Nord Stream 2 gas pipeline project, which is being built to provide Europe with Russian oil. In July, Germany's previous government already agreed to be willing to use this tactics as a tool to stop another Ukraine invasion, though it would indeed hurt Europe as much as it would Russia. This would seriously hose Russia's potential future income streams and be a big loss for them too, though. Some of the other tools for diffusing the situation would be putting sanction on Russian banks as well as on Russian exports. Biden has also told Russia that he would be willing to support the Ukrainian military against a Russian invasion if necessary. Now, these kinds of sanctions have been moderately effective to a degree in the past, so we'll see how Russia responds in the coming days. Both an invasion of Crimea as well as shutting down the Nord Stream 2 project would have massively negative effects on the European economy and the world economy overall, I think, though the last invasion didn't exactly crash the market back in 2014. But I think in combination of any of these following points, it could devastate the market's push towards all-time highs. Next, the Great Resignation. In a surprising twist to the neck-breaking shift to work from home, just as rapidly we're seeing millions of people quitting their jobs internationally. The US lost about 4 million workers in September, and I think there are numerous reasons for this actually. While the work-from-home transition removed the hassle of in-person meetings and a commute, for many people, it also realized a loss of personal connection, along with growing frustration with technology. You know, doing a meeting over Zoom is never going to be the same as it is in person. But even more, I think a lack of control from employees, combined with more aggressive oversight and surveillance, also boosted the feeling of alienation by a lot of people who shifted to work from home. And in many cases, when a couple of people quit from a company, that portion of their work is just thrown onto the remaining staff without any according compensation boost, raising tensions further and exhausting the last one standing. This is happening in blue collar and white collar work. Seems like there's also been a realization that the dual parent hustle to get more and more stuff and be more and more in debt can be a stupid pursuit for a lot of people. So if you're working to make $2,000 a month and then you're spending $2,500 of that on childcare, you might as well just work at home and be the childcare. It's stupid to work, So a lot of people are realizing all these different things and just being why am I even working? And while we're seeing the consumer price index continue to climb, telling us that inflation is growing pretty rapidly, we're definitely not seeing a commensurate boost to wages, prompting many to, understandably, quit their jobs. Many have felt a lack of COVID-related protection from their employers, causing frustration, and in many states, vaccine mandates are causing others to be forced out of employment as well if they're unwilling to be vaccinated. In Microsoft's 2021 Work Trend Index, they found that more than 40% of the global workforce is considering quitting their jobs in 2021. Interestingly, the Harvard Business Review mentioned that 30 to 45-year-olds are showing the fastest increase in resignation rates, which has increased by more than 20% just from the last year alone. This suggests that the Great Resignation isn't limited to high school fast food workers like many are hoping it is. Now, I personally think that the shift to work from home has probably boosted productivity and efficiency in many companies, especially those like Dropbox who've straight up opted out to let go of their leasing obligations on their corporate office, and it's just permanent work from home from now. And this is going to be saving them hundreds of millions of dollars in the short term and even more long term. It's going to be a really difficult balancing act, especially for tech, to make this big transition in a way that properly rewards employees for taking on so much more work. But I think if they can't begin to solve these problems soon, the drag on the overall economy could end up being significant. And that could potentially end up hitting stocks in the overall market in the wallet sooner rather than later. But combine that with everything happening with supply chains and we multiply the threat level twofold. The New York Times put together this neat animated website that unravels as you scroll through the different stages here, but simply stated, the pandemic caused labor shortages in production as well as in supply chains. Then those strained supply chains got overwhelmed by increased online shopping and demand for PPE, which was mostly coming out of China. And now most of the world's largest ports are seeing weeks worth of backlogs piling up despite a shift to 24/7 work in some cases. I think some naively tried to simplify this problem, saying that the US just has such a magnificently powerful economy and so much pent-up demand from the last year and a half that the system can't handle all of it. But the reality is that it's tied to so many other factors, including the Great Resignation, as well as pandemic shutdowns internationally, as well as probably in some cases increased demands for things like computers and webcams because we're all working home from now, putting further the demand on the overwhelmed microprocessor shortage too. Now, what does this mean for you and me as investors? There are a few different ways we can look at this, and one of the ways I'm taking advantage of it is by investing in shipping companies to bring some balance to my tech-heavy portfolio, for example. But taking a moment to consider that these issues aren't something that can physically possibly be solved in just like a week or two, and how that might impact the growth of, especially retail companies, is probably a good idea if you're invested heavily in those. We should also consider the fact that the pandemic probably brought a lot of purchasing forward of things like cars or computers or other tech or like larger, retail type purchases from the future when they would have normally been made. Supply chain frustrations have also caused retailers to double book their orders with factories to ensure that they'll be able to get the amount of supply they'll need. And at some point in the future, that will all get where it's supposed to be going. And what happens when inventories skyrocket? Prices have to come down, right? And in some cases, when prices come down, while it's not necessarily bad for the consumer and could be interpreted as inflation, it could also bring with it further workforce reductions or restrictions on wage growth too. And I agree with ARC's Kathy Wood, even though she obviously isn't the most popular person in the world right now, that we're likely to see something like a recession in 2022 once all of this overwhelm of inventory starts to hit home. Next, if you've been following the EverGrande drama in China, you're probably already familiar with the fact that numerous really, really large property development companies are teetering on the brink of collapse, which could have far-reaching impacts on China's economy, and then dominoing into international markets too. Aoyuan, the 35th largest of these major developers, while trying to stave off collapse, has seen its dollar bonds plunge to 20 cents on the dollar. In China, because communism, the only way for the vast majority of people to be able to attempt to amass some kind of wealth for their families is through real estate and investing in speculative real estate, basically. And when there's a frenzy of buying, pushing developers to overextend production, and all of this is funded by massive amounts of leverage, as soon as things like the global pandemic starts, the dominoes are triggered. And a few small defaults can lead to projects being delayed, refunds being demanded, bank repayments being delayed or canceled, and then defaults start to spread like wildfire, right? And the more defaults happen, the more defaults happen. not unlike what we saw in the US in 2009. So in response to this, China slashed the reserve rate requirement ratio for banks in China down to 5%. Now, banks who make money by making loans are only required to hold a small percentage of their total active loans on hand. So for example, a small bank might have $100 million out on loan, people, mortgages and stuff like that. But if there's a 5% RRR, or reserve requirement ratio, they would only be required to actually hold 5 million of that, in their vaults to prevent some kind of run on the bank or collapse. I believe the US has had their RRR at 0% for a while now, which is actually quite disturbing if you stop to think about it, but has also been responsible for helping the markets grow. China's move to lower their RRR will free up cash to flow throughout the economy and provide some relief to avoid financial collapse from this leverage-fueled real estate development boom. And so it's hard to say what's on the horizon for China's economy with all this leverage going on. And in the past, not just in China, but in other places too, when there are leverage-induced bubbles going on, they tend to burst in rather violent fashion. But Chinese leadership has a few more tools at their disposal than many others do, and they haven't been in a recession for more than 20 years as a result. The wealth of the average Chinese citizen has exploded in a big way in that same period, and China's determined to stay on track for growing common prosperity. But let's add to that the uncertainty that China's anti-Taiwan rhetoric brings to the table, and we have a potentially very explosive powder keg on our hands. Locally, China plays down this threat when media outlets discuss an invasion of Taiwan, suggesting that the democratic island nation 30 miles off the coast would immediately roll over in surrender. But Taiwan's allies, like the US and Japan, realize that a move like this could potentially amount to the beginning of something along the lines of World War III. While China has boosted the frequency of their naval drills in the Taiwan Strait as a show of strength, the US, Japan, and their allies have begun to prepare for the reality of an invasion. While Taiwan is really small in relation to China, their ideals, economy, location, and partnerships are crucial to their allies, and both Trump and Biden have made clear that they're not okay with China making any moves against Taiwan. Connecting the dots between some of these points I've mentioned earlier, Taiwan Semiconductor, the largest microprocessor contract manufacturer in the world, who has recently announced expansions into Japan and the US to ease the worldwide supply shortage, would be an obvious example of how world economies and supply chains could be shattered in the event of an invasion. The world's largest company, Apple, heavily depends on Taiwan Semiconductor's tech and expertise and output capacity for many of its products. While there's not a super duper high chance of an actual invasion happening immediately, especially with another election on the horizon for Xi Jinping next year, we shouldn't dismiss this idea. I think Russia's more likely to shrug off any sanction threat and make a move on Ukraine than China is to Taiwan. But with the US being heavily involved in both of these scenarios on opposite sides of the world, both of these happening in a similar time frame is pretty much guaranteed to wreck world markets for a while, I think. And finally, as if we didn't have enough uncertainty on our plates, we have Powell's re-election to the Fed chairman and his subsequent super juke move of basically switching on us from being a dove to being a hawk. And you cannot fight the Fed. Remember this. If you're only getting one thing from this video, remember this. You can't fight what the Fed is doing. And I'll explain what that means. Before his re-election, which was decided a couple of weeks ago, the case was basically that keeping money flowing predictably into the markets would be a smooth transition out of what Powell called our transitory inflation problems. As the Fed chairman, the Fed aims for three different things. One, full employment in the US. Two, stable prices, not insane inflation. And three, moderate long-term interest rates, which we're also not really, seeing now either. Dovish Powell, his alter ego, which existed before his re-election, believed that the inflation we're seeing now is short-term and will resolve itself soon. After printing something like 40% of the current amount of US dollars in existence in the last year and a half, on the back of super low interest rates, while it's helped the economy avoid disaster, it's also caused more inflation than most people are willing to deal with. And that's caused jobs growth to slow down massively, adding only 210,000 jobs in the last report, when pundits were expecting 535,000 in November. And we can connect the dots with all that we discussed earlier with the Great Resignation as well. So Biden's chosen this loose money dove named Powell once again, but now they realize that they're going to have to eventually reduce quantitative easing, which is basically printing money, keeping money flowing into the system, and at the same time raise interest rates to fight against this inflation if Biden's ever going to hope, to get reelected again. So making moves like that gets you labeled a hawk. My personal opinion is that when you're too dovish and you're just printing money crazy and keeping interest rates super low, yeah, it looks good and feels good for the market short term. We're talking like over a couple of years, but you're also borrowing that wealth from the future by forcing inflation and raising prices. And we all know that rising prices suck for consumers. So throughout history, we've seen this pendulum swinging between dovish Fed and a hawkish Fed. And we're seeing that pendulum swing back the other way once again. But pretty much every time we go dovish and quantitative easing is stepped up, we see a commensurate growth in the economy, or the stock market, and I guess the economy, following that, because it's easier and cheaper to get money to grow your businesses. Add to all of this the fact that there's more margin debt in the market, meaning people leveraging their investments than ever before, and that means the smallest downturn could lead to margin calls, which could lead to the domino effect similar to what we were talking about earlier with China, leading to more and more rapid collapse than many are prepared for. On the flip side, when interest rates are increased, there's more motivation to take your money out of risky stocks and put them in safer bank deposits, bringing a lot of cash out of circulation. This slows growth, but it also constricts inflation and is probably exactly what Biden and Powell are hoping to achieve. And that's where the phrase, "you can't fight the Fed," comes from. Many people who've seen this effect at play, called the QE effect or the quantitative easing effect, have managed to grow their investments long-term simply by monitoring what the Fed is doing with QE and acting accordingly. When they're hawkish, avoid losses by easing out of stocks. And when they're dovish, just throw whatever you can into the market because it's going to go up. So Fed behavior is likely going to be the biggest drag on stock growth in North American markets for the coming period. But add to it all the potential powder keg conflicts going on in the world, and we could see some unprecedented pain in the market at literally any time. So what should we do to prepare? I'd be super interested to hear your thoughts in the comments section, but what I'm going to do is, number one, I'm going to go heavier into cash. If you've been following my channel, you've seen that I've switched my style to be a bit more active with a small portion of my portfolio rather than being purely super long-term buy and hold. But I'm also going to attempt to keep more cash on hand and readily available for a very drastic downturn. And I'm not talking like YouTuber speak, calling it a market crash with exploding thumbnails whenever the market dips 2%. I'm talking like an extended period where we're down like 20% plus from these all-time highs because of all this deflationary pressure from the hawkish Fed and potential uncertainty in the world. So I'm keeping an elevated amount of cash on hand with somewhere around 30 to 35% in my long-term hold stocks and cryptos, with a lower ratio of probably like 25 to 35% in my shorter term plays that are more likely to get melted by transition to a risk-off macro, and something like 30% or more in cash available for opportunities. I think that's probably more cash than a lot of you guys are willing to keep on hand. And again, keep in mind that all of this depends on your situation. For me and our family situation right now, especially with twins on the way, keeping that amount on hand makes sense. I did manage to pick up some deals in the last few days, but those are really just tidbits of where I would like those positions to end up in the coming years. It's super hard to resist buying more when you see 5 or 10% drops like in one day, what we've seen the last couple of weeks or the last week or so. But I'm really convinced we can't keep going much longer at these rates with these Fed moves and all the other drama happening too. If you found this helpful and would like to learn how you can capitalize on the world supply chain drama, check out this video here. Love you guys and stay generous.